Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And today we're going to talk about the investment journey, where we're at today, and how to prepare for an unknown future ahead. And as a caveat, we're recording this a month or two ahead of it being released, so there's a very high likelihood that when you hear this, the stock market won't be at the exact same spot as the time recording.
Wait, is that a call on the stock market there, Andrew?
Yeah, and a pretty bold one at that.
Yeah, really sticking your neck out there saying the stock market won't be in the exact same spot a couple months from now.
I really am, and fortunately that won't impact what we're going to talk through today. So like I just mentioned, we'll walk through the investment journey, starting with where we are at today. And by today, I mean after a period of very strong market returns. So we'll break this down into a few different areas. Number one, a quick recap of what's happened over the past 2 years. Number two, adding perspective around what's happened over the past 2 years within the bigger picture of the investment journey. And number three, we'll touch on lifeboat drills and why they're important following periods of strong market performance, which this feels like our first semi-creative hook or concept that we've had in the podcast.
Which this all seems like we're setting the bar pretty low, but we'll go with it.
Well, I guess that's the easiest way to clear it. And then number four, and outside of the lifeboat drills, the last area we'll touch on is how you can apply all the concepts to your unique situation and what you should consider doing or not doing. So Trent, why don't you start us off by giving a quick recap of where we stand today relative to March of 2020?
Sure. Well, the short answer is up a lot, but just to elaborate a little more, the theme has been pretty consistent over the past couple years, which is that almost everything, at least as it pertains to the stock market, has recovered faster than expected. If you think back to February and March of 2020, the stock market experienced a sharp 35% decline in less than 2 months as COVID was first emerging and people were expecting the worst and there was no visibility or end in sight at the time. Well, like a rubber band, following that sharp pullback, there was an equally sharp recovery that has been going on since late March of 2020, which it didn't necessarily feel like it on a day-to-day or month-to-month basis, especially early on in the recovery, since the headlines were negative and we were still facing many of the same concerns around COVID that caused the decline in the first place. And looking back at that time, there was a picture, which we included in our quarterly newsletter to clients, that perfectly summarized the disconnect between how people felt and what was actually happening in the stock market. The picture was Jim Cramer on CNBC with a headline that said, "More than 16 million Americans have lost their jobs in the past 3 weeks." But there was also a graphic in the background behind Cramer that said, "The Dow Jones best week since 1938. Said differently, the stock market had just experienced its best weekly return since the Great Depression era, despite 16 million people having just lost their jobs.
Yeah, I mean, it's like we always say, the stock market is easy to predict and always makes sense, right?
Yeah, exactly. It's very intuitive, especially since there are never any human emotions involved. But like most things, it's always easier to make observations in hindsight about what happened and how you should have reacted at the time. It's no different than watching a football game and giving your 2 cents after a bad play saying, "I knew Michigan should have passed the ball on 4th and 1 instead of running it." Which, with investing, looking back over the past 2 years, the now obvious answer is that I should have invested more in March of 2020, or I knew I shouldn't have gotten out of the market and then gotten back in too late in the recovery. However, it's almost never felt quote-unquote good to invest more during this run-up we've seen after the COVID-related pullback. It's that cruel irony of investing where, instead of being happy or grateful for periods of strong market performance, human nature leads us to fear what's ahead or think that this is too good to be true. And even though the concerns around COVID are still very much present, in recent months new concerns have surfaced around inflation and new variants of COVID popping up that can cause uneasiness about investing. Despite the uneasiness that has been consistently present, support from government fiscal policy, the Fed keeping interest rates low, and companies adapting and rebounding much faster than expected, has resulted in companies reporting better than expected earnings, which is what drives the stock market up over time. So the punchline here is that the past 2 years have been a really strong period for investors who simply stayed the course and managed their emotions. More recently, we started to see some smaller pullbacks based on the latest concerns or narratives being shared by the media, which can lead to angst for investors. We know that hearing the various media headlines can be unsettling, especially after a period of strong stock market performance that came against an uncertain backdrop for the country and the economy, and this can lead people to extrapolate different what-ifs and concerns with the stock market. However, it doesn't have to be this way. Rather than letting your emotions dictate your decisions or trying to speculate about the future, a better approach is to maintain perspective about where we are today and put it into context of how the stock market behaves over time to decide how you should or should not adjust your investment portfolio.
Yeah, this is a recurring theme we bring up, which is the importance of managing your emotions. And as Trent just walked through, despite this being one of the best periods for the stock market, it rarely ever felt like that, at least for the vast majority of people. Said differently, the vast majority of people were stressed or concerned about the stock market going down while it was going up 30%, 50%, and 70% plus. So if people are concerned about the stock market when it's going up that much, you can imagine how big of a role emotions play when the stock market is going down. It's human nature that we dislike losses more than we like gains at a 2-to-1 ratio, and this comes into play during stock market pullbacks like March of 2020. But the point here isn't looking at what's happened over the past 2 years and using that as some meaningful measure to predict what's to come. Instead, it's to use a recent example to help reframe your perspective around investing being a journey rather than a destination. With that in mind, it's worth pointing out how unusual it is for the stock market to essentially only go up for as long as it has without any material declines. Looking over the past 30 plus years, the stock market, as proxied by the S&P 500, has an average intra-year peak-to-trough decline of roughly 14%. Or said differently, throughout any given year, there tends to be a 14% drop in the value of the stock market. Now, it certainly doesn't mean the stock market ends up being down 14% for the year, at least looking from any given January to December time period. It just means that at some point throughout the year, you should be prepared to experience a 14% decline. This is what a quote-unquote normal year looks like for the stock market. What's abnormal is to have a year where the stock market only goes one direction, which is what we've experienced. On top of being prepared for a 14% decline, the stock market also has an average pullback of 20% or greater 1 out of every 5 years, and a decline of 30% or more 1 out of every 10 years. Of course, these are just averages, which don't ever play out exactly as they're supposed to. It's kind of like saying the average family size in the US is 2.4 kids, yet do you know any families with exactly 2.4 kids? So knowing what, at least on average, you can expect from the stock market can help you better manage your emotions when the stock market goes through its next temporary decline. This isn't to say every investor needs to have a pessimistic view of the stock market at any given point, but every investor should be rational with their expectations. And the way we look at the stock market at any given point is what we call rational optimism. We're optimistic about the future trend of the stock market being up over longer periods of time, thinking decades and not months, since that's all it has ever done. Yet we're rational about the realities of investing, where there will be many temporary declines, varying in magnitude over the course of every investor's lifetime. This is why we view investing as a journey rather than a destination. We know people like to cite or look at what the stock market has done over any arbitrary time period, like 1 year, 3 year, or 5 year performance, yet somehow people don't seem to care as much about 265-day, 523-day, or 894-day performance. So after or during periods of strong market performance, it's helpful to remind yourself of the inevitable declines that will be coming at some unknown point in the future to avoid being surprised and making a mistake based on emotions. And we like to describe these friendly reminders to ourselves and clients as lifeboat drills, which, thinking about a lifeboat drill, the time to test the lifeboats to ensure they work and you know how to use them isn't when a boat is sinking, but well ahead of them so you can be prepared.
Yeah, and thinking about these lifeboat drills through an investing lens, the time to prepare for a stock market decline isn't after it's down 10, 20, or 30%, but instead when everything is going well. The goal of a lifeboat drill, or preparing yourself for the next inevitable, albeit temporary, stock market decline, is to avoid being surprised when it does happen, or making any decisions in that moment when emotions and fear come into play. In many ways, you can think about this like your tax bill. If you knew you'd owe $10,000 in taxes come tax time, you could plan ahead and make quarterly estimated payments or increase your tax withholding. Whereas if you only found out about the $10,000 tax bill when you went to file your tax return, you may have some unpleasant emotions and or want to avoid experiencing that again in the future. So when it comes to lifeboat drills, it's not an overly complicated or exact process you need to follow. The goal is to provide reminders to yourself that allow you to maintain the proper perspective. AKA, after the stock market has gone up 80%, I shouldn't be surprised or overly concerned about the next 10% or 20% decline. That's not to say you completely ignore what's going on in the world or that the problems that are causing the temporary decline don't have merit, but you should remind yourself that this is a normal part of investing and embrace the fact that these temporary declines are the exact reason you're able to capture a better long-term return by investing in the stock market rather than just keeping your money in cash where it feels safe day to day, but doesn't provide a return on your money that'll keep up with the rising cost of living over time. So step 1 is to remind yourself of the realities of investing and have the proper perspective about where we are in the investment journey. Step 2 of a lifeboat drill is to reassess your investment allocation, which is your mix of investments, and specifically what percent you have invested in stocks versus bonds. You may be getting closer to retirement, or you may have run retirement projections and realized you're now well ahead of schedule, or maybe you just have an honest realization that the last temporary stock market decline caused you a lot of stress and you don't know how you'd react or whether you'd be able to stay the course with your current investment allocation if that happened again in the future. If any of those areas have changed or you feel an adjustment is warranted, the time to make that change is when things are going well and it's easier to think rationally, as opposed to when the market is going the other direction and emotions take over. Having said that, it's important to remove any speculation or guesswork from this decision-making process. Changing your investment allocation because you think the stock market is going to decline isn't a sound approach, at least in our opinion. And the reason for this is perfectly captured by what's happened over the past 2 years, where all along the way, many people felt the stock market was going to decline or that it had risen too fast, yet it defied expectations and continued to march upward. So in basic terms, what you want to do is avoid the temptation to make investment decisions based on emotions or predictions, since emotions almost never help this type of decision making and nobody can consistently time or predict the stock market. If when you revisit your investments, you realize you've quote unquote won the game or simply can't deal with having as much exposure to the stock market during the next decline, it's okay to make an adjustment when times are good. Sure, you may miss out on some potential upside, but you're making a rational and intentional decision about what works best for you. And assuming this change won't impact your ability to meet your goals, you don't need to chase the absolute best possible investment return at all times just for the sake of it. And you can instead focus on figuring out the right investment mix that helps you sleep well at night. Now, the last step of a lifeboat drill is to be prepared for and have a plan for what you will or won't do during the next temporary stock market decline. For example, one option could be keeping a chart that shows what the stock market has done since the day you were born. What you'll see is a line that moves up and down over any given year, but is significantly higher now than when you were born. The idea here is the reverse of what you're doing when mentally preparing for a stock market decline, which is to have a positive reminder ready for when you're actually experiencing that stock market decline and things feel bad at the time. When the headlines are getting more and more dire and it starts to feel different this time, you can have a helpful tool that effectively says, "This too shall pass," and allows you to broaden your perspective by focusing on the positive long-term trend and historical evidence. Another way to prepare for how to respond to a stock market decline is to put together a disciplined plan for what you'll do with your investments. This could be a set of parameters that if the stock market declines by 10%, then you'll rebalance and buy more stocks at a discounted price. Or if you have a taxable account, maybe your plan will be to take advantage of tax loss harvesting if any investments are down $5,000 or more. Whatever the situation, it can be helpful to have set decision rules where if X happens, then I'll do Y, since this removes in-the-moment decision-making, since the decision has already been made in advance when things felt better and emotions weren't at play. And of course, the last option is that you can decide you'll simply do nothing and wait for the storm to pass. And sure, you may miss out on some incremental benefits from being proactive with the things you can control during a market decline, but it's far better than the alternative of making an impulsive or irrational decision in the moment.
Exactly, and this is one of the few areas in life where you can actually benefit from literally doing nothing.
Wait, are you saying that strategy of doing nothing hasn't worked for your fitness regimen?
Yeah, and same with the strategy of not working for my golf game, which I should actually be better about my lifeboat drills around my score at the end of the round.
Yeah, I think we should start to add that to the beginning of each round. Don't panic if you see triple digits.
Yeah, fortunately, we have pretty low expectations there. So tying everything together, we wanted to use where we're at today to help with how you can prepare yourself for what's to come, which no one can predict. And yes, despite how confident, boldly, or loudly someone states a prediction on CNBC. And this is meant to be a broader framework that you can apply across all market environments, which is to acknowledge where we are today, have the proper context of the range of possible outcomes in the near term, while having an optimistic long-term view, and then applying this to your unique situation to decide if any changes are warranted. This is an ongoing process, which is refined and adjusted over time, as your investment time horizon changes, tolerance for risks adjusts, or simply how ahead or behind you are toward meeting your goals. Like Trent mentioned, if you're ahead of schedule toward retirement, funding college, or any other goal, you may decide that you no longer need to have as much invested in the stock market and can make a shift toward a mix that's more comfortable for you. Once you accept the realities of investing and armed with the right mindset, you can make intentional decisions based on the trade-offs you're comfortable making, and this helps you retain a sense of control. Having this sense of control over your decisions further helps you to remove the emotions of investing. For example, let's say you decide several months ago that you would have a lot of trouble sleeping if there was another 20% decline based on your current stock exposure. And by doing this, you knew and were okay with giving up the potential upside. It makes whatever comes next a lot easier to stomach. If the market continued to go up and you missed out on a 5% return, you'll know this wasn't because you made a mistake or sold something because of a speculative headline, and instead did this fully knowing this could happen, and you weighed the potential risks of a decline happening as more important. On the flip side, let's say the market goes down. Well, you'll clearly be happy with your decision in the near term, and you will have helped to avoid the feeling that you may have to see an even larger decline, and then wait until it goes back up again before adjusting your allocation. Regardless of what happens, it takes the guesswork or second guessing out of the process, and helps people strike the right balance for them. And we should probably apologize if anyone made it this far and was hoping for a recommendation of doing XYZ because of this headline or what's going to happen in the future.
Well, you did make that bold prediction that the stock market won't stay in the exact same place.
Yeah, I almost forgot about that. Well, there you go. I'll take back that apology. And joking aside, we hope this was helpful for everyone listening, regardless if this is the first time hearing our perspective around investing or if you've listened to other episodes as well. The punchline and message around investing is always the same, which is to focus on what you can control and plan around what you cannot. However, we know, like most things, it's easier said than done, which is why we like to apply and discuss practical ways of implementing our core message and ways to better manage the emotions of investing. So to give a quick recap of what we discussed today, number one, and as Trent stated with the punchline, the stock market has been up a lot over the past 2 years. Yet it likely didn't feel like this along the way. We're here, at least at the time of recording, with the stock market still being at or near all-time highs. This was a sharp recovery from the 30% plus pullback in March of 2020 and serves as a reminder of the contrast that can exist between how things feel on any given day and what the stock market does. Number two, knowing the stock market is close to all-time highs, whether it's now or at some point in the future, it's helpful to have the proper perspective of how the stock market behaves over time. Remember, the stock market has an average annual peak to trough temporary decline of roughly 14% every year, a decline of 20% or more, roughly 1 out of every 5 years, and a decline of 30% or more, 1 out of every 10 years. This isn't about making a prediction, but rather accepting the realities of investing and having a healthy dose of rational optimism. Number three, we touched on the importance of lifeboat drills when things are quote-unquote good with the stock market being up. As part of the lifeboat drills, you want to be proactive with what you should do today and how to help yourself in the moment with a plan of what you will or will not do during the next temporary stock market decline. And lastly, number four is to realize that investing is a journey rather than a destination, and everyone is unique with what life stage they are at, with different views on what's most important to them. So the goal is to make intentional decisions of what will help you best navigate investing over multiple decades while being fully aware of the trade-offs of your decisions. Well, thanks everyone for joining us for another episode of the show. If you want to check out the show notes, you can find them at mdwmllc.com/podcast. And as always, you're also welcome to email us at info@mdwmllc.com if you have any thoughts or questions you'd like answered. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.